Look at a screen right now, and you will see the price of silver sitting near $79. It looks peaceful. It looks like just another day of range-bound trading in the global markets. But that number is a lie. It is a digital mask, an illusion born of paper contracts and algorithmic high-frequency trading that has completely detached itself from the physical reality of the world we live in. We have become so hypnotized by flashing green and red pixels on a monitor that we forget a very brutal, very physical truth. Commodities are not lines of code. They are pulled from the crushing weight of the earth with heavy machinery, sweat, and far too often, human lives. While paper traders in air-conditioned skyscrapers were busy trading imaginary ounces that will never see the light of day, the true story of silver was being written in smoke and fire in eastern Kazakhstan. On Tuesday, May 5th, 2026, a massive explosion ripped through a dust collection unit at the Kazakh facility in Ust-Kamenogorsk. This is not some minor secondary operation. Kazakh is the largest producer of silver and gold in the entire country, a vital artery in the global supply chain. The blast was powerful enough to cause a partial structural collapse and trigger a massive fire. 2 workers were killed instantly, and the number of injured has now risen to 9. The human cost is a tragedy, but the economic consequence is a ticking time bomb. Instantly, 3,400,000 ounces of expected annual silver production vanished from the global balance sheet. And yet, the paper price of silver barely moved. If you are someone who is tired of being lied to by a financial system that pretends physical reality doesn't matter, make sure to hit the subscribe button and give this video a thumbs up, because the disconnect I am about to show you is the exact signal that precedes a total systemic collapse. To understand why $79 is a mathematical lie, you have to understand the concept of the inventory mirage. We have been conditioned to believe that the global supply chain is an infinite vending machine. You put your money in, and the product comes out. But the silver market has been fundamentally broken for over half a decade. For 6 consecutive years, the world has consumed more silver than it has pulled out of the ground or recycled. 6 years. This is not a temporary disruption. This is a structural decay. In the year 2025 alone, the global deficit was estimated at over 100 million ounces. Some conservative estimates from the Silver Institute put it at 67 million ounces, while institutional research from banks like JP Morgan projected a cumulative physical deficit reaching 245 million ounces by 2026. Imagine a family that spends 30% more than it earns every single month, year after year. They do not collapse immediately. They survive by draining their savings accounts, selling the furniture, and leaning heavily on credit cards. That is the silver market right now. We are draining the savings account of the world. The stockpiles that have been built up since the 1980s are quietly disappearing into solar panels, electric vehicles, and artificial intelligence data centers. These are industrial applications where the silver is consumed in such tiny, integrated amounts that it is almost never recycled. It goes into a landfill and is gone forever. The cushion is gone. We have officially entered an era of reduced stocks. And into this bone-dry, highly combustible environment, the disaster in eastern Kazakhstan acts like a lit match dropped into a powder keg. 3,400,000 ounces. That is the amount of expected annual silver production that was instantly erased when the dust collection unit exploded at the Kazakh facility in Ust-Kamenogorsk. On a global scale of 820 million ounces of annual mine production, a surface-level analyst might tell you that 3 million is just a rounding error. It is barely 0.5%. But markets are not priced on total volume. They are priced on the margin. When a market is already running a deficit of 100 million ounces, every single ounce becomes a battleground. When you remove 3,400,000 ounces of physical supply from a system that is already bleeding, you are not just tightening the market. You are accelerating the timeline of a physical squeeze. The industrial buyers, the corporations building solar farms and manufacturing defense components, they do not panic buy the minute a mine explodes. That is not how procurement works. They check their warehouse inventory. They call their suppliers. They assess how many weeks they can keep the assembly lines moving with what they have. The physical market moves slowly, deliberately, over weeks and months. But when it finally realizes that the replacement metal is not coming, it moves violently. So why is the price on your screen sitting at $79? Why did the market not explode the moment the news out of Kazakhstan broke? This is where the dark mechanics of our financial system reveal themselves. The price you see on your screen is not the price of physical silver. It is the price of a digital derivative. It is a futures contract traded on the COMEX or the London bullion market. It is a paper illusion dominated by algorithmic trading systems, hedge funds, and institutional short sellers who trade millions of imaginary ounces back and forth in milliseconds. Right now, on the COMEX, The open interest of paper claims is sitting at roughly 153 million ounces, while the registered physical metal actually available for delivery is hovering around 77 million ounces. That means for every one real, tangible bar of silver sitting in a vault, there are roughly 2 paper claims asserting ownership over it. The entire pricing mechanism of the global silver market relies on a gentleman's agreement. It relies on the absolute faith that those 2 paper holders will never show up at the loading dock at the same time and demand to put the metal in a truck. This is not a new game. We have seen this exact scenario play out before, and the ending is always the same. Go back to the 1960s and look at the London gold pool. The central banks of the world conspired to peg the price of gold at $35 an ounce. They dumped paper contracts and physical reserves onto the market every time the price tried to rise. For years, the suppression worked perfectly. The paper price stayed flat. The financial press praised the stability of the system, but underneath the surface, physical buyers who understood the math were quietly draining the vaults. The disparity between the artificial paper price and the physical reality grew wider and wider until one day, in March of 1968, the physical drain became so overwhelming that the central banks threw in the towel. They closed the London gold market, and when it reopened, the price skyrocketed. Paper suppression always works flawlessly, right up until the exact moment that it doesn't. And when it breaks, the repricing is instantaneous and brutal. We are watching the modern equivalent of the London gold pool playing out in the silver market right now. While the algorithmic traders are completely ignoring the missing metal in Kazakhstan, they are obsessively trading the macroeconomic headlines. And for the last several months, those headlines have been a suffocating weight on the precious metals sector. We had the closure of the Strait of Hormuz. We had geopolitical tensions in the Middle East, driving the price of oil above $109 a barrel. That massive spike in energy costs forced inflation back up, which in turn forced the Federal Reserve to freeze interest rates. High interest rates mean a strong dollar, and a strong dollar has historically been the heaviest anchor you can tie to the price of silver. This chain of events is exactly why you watch silver plummet from its highs of $121 down to the low 70s. It was a macro-driven, algorithmic sell-off. But look at what is happening right now. The tectonic plates of the global economy are shifting beneath our feet. We are seeing credible reports of diplomatic progress between Washington and Tehran, mediated by Oman and Pakistan. The framework proposal to separate the Strait of Hormuz issue from the broader nuclear negotiations is gaining real traction. And what is the immediate result? The price of crude oil is dropping from $109 down toward the mid-80s. That is a massive deflationary sigh of relief for the global economy. As energy prices cool, the inflationary pressures that had the Federal Reserve backed into a corner are beginning to ease. The Consumer Price Index data is starting to reflect this reality. And the timing of this could not be more critical. In exactly 10 days, Kevin Warsh takes over as the chair of the Federal Reserve. This is a monumental transition. Warsh has built a reputation as a hawk, but his own written words tell a much more nuanced story. He has clearly signaled that he views the current economic landscape through the lens of artificial intelligence and massive productivity gains. He believes that technology is fundamentally changing the inflation calculus, and he has expressed a willingness to use different metrics that strip out temporary supply-side shocks. We have a new Fed chair walking into the building at the exact moment that oil prices are dropping and inflation is cooling. The narrative is shifting from higher for longer to the very real possibility of rate cuts in the second half of 2026. The massive headwind that has been suppressing silver is turning into a tailwind. This brings us to the most insidious part of this entire cycle: the psychology of the retail investor versus the positioning of the institutional banks. If you bought silver anywhere near the peak, you have spent the last few months living in a psychological meat grinder. Watching an asset lose 40% of its paper value is not just a financial loss, it is a test of your mental endurance. Human beings are biologically wired to interpret financial loss as physical danger. When the price drops week after week, the primitive part of your brain screams at you to run away, to sell, to stop the pain. A quiet voice in the back of your head starts asking if you missed something. Did you get the story wrong? Are you the sucker at the poker table? This is exactly how the market transfers wealth from the impatient to the patient. The 40% corrections are the toll you pay to participate in a historic bull market. They shake out the weak hands. They force the retail crowd to sell their physical metal back to the banks at a discount. Because while the retail investor is panicking over a $79 paper price, look at what the institutions are doing. The banks that manipulate the paper markets are the exact same banks quietly stockpiling the physical metal. Their own internal research departments are broadcasting the truth if you know where to look. Before the mine explosion in Kazakhstan even happened, Goldman Sachs had published targets pointing to silver at $95 within 12 months. UBS was modeling a spike toward $100 in their bull case scenario. Citigroup was openly calling for $150 based purely on the sustained physical shortfall and the inevitable weakness of the United States dollar. These are not fringe internet bloggers. These are the architects of the financial system, and they are telling their high net worth clients that the math no longer works. They run the numbers on a 245 million ounce deficit. They factor in the Shanghai Gold Exchange, where buyers in China are consistently paying a massive premium over the London spot price just to secure physical delivery. When Shanghai pays a premium, it means the competition for real metal is severe, and now those same institutional analysts have to go back to their spreadsheets and factor in the immediate loss of 3,400,000 ounces from Kazakhstan. The supply shock did not happen in a vacuum. It happened at the exact moment that the macroeconomic suppression chain is breaking. You have to understand the difference between timing a market bottom and positioning yourself for a paradigm shift. No one catches the absolute bottom. Not the algorithms, not the hedge funds, and certainly not the retail trader. Bottoms are only obvious in the rearview mirror. In real time, a market bottom feels identical to a market that is about to crash another 20%. It feels terrifying. But positioning is different. Positioning means you look at the board, you do the math, and you place your chips before the rest of the world wakes up. Right now, silver has tested the low 70s 3 separate times. 3 times the paper price was driven down, and 3 times the physical buyers stepped in and built a floor. That is a triple bottom support. The barometric pressure of the financial system has shifted. The storm is visible on the radar. The supply is gone. The demand is rigid. And the paper illusion is running out of time to hide the truth. The global financial system is a game of confidence, and confidence is remarkably fragile. It assumes the physical world will always bend to the digital one. But history is a graveyard of paper illusions shattered by one undeniable truth. Reality eventually becomes too loud to ignore. You are living through one of those moments. The smoke from Kazakhstan is a reminder that you cannot print silver. When the paper walls finally dissolve, only what you physically hold will remain.